So far, we have learned the accounting equation is made up of assets equals liability plus owner's equity. Okay, today we're going to take a look at some transactions that are actually going to break down this owner's equity into 4 different categories. Okay, and that's going to be revenues, expenses, withdrawals, and capital. Okay, so we're going to look at some transactions, business transactions that will affect those new accounts that we're going to take a look at. All right, so let's begin with revenues. It's the best thing for a business because revenues is the amount earned by a business. They are fees. So fees is a key word. Okay, fees earned for performing services. It's income from selling merchandise. It's rental income, interest income, any kind of money that's coming in. When you think of revenues, when you look at business transactions, there are 2 words that should key to you that it's a revenue. And those 2 words are fees, like I have underlined there, and sales. Okay, so that means that that's money coming in. It's a revenue. It's an income. Okay. Next, we will look at expenses. So no one likes to spend money, but it's necessary. And expenses are the costs that relate to earning revenue, basically the cost of doing business. Okay, so it can be everything from paying your employees, which is wages, your rental expenses, interest expenses for your credit cards, advertising expenses, all that kind of stuff. It's the cost of doing business. Now we look at this umbrella of owner's equity that I showed to you before. And we know that assets equal liabilities plus owner's equity. Inside of owner's equity, there are 4 things: drawing, expenses, capital, and revenue. You are familiar with capital, okay? Capital is when the owner invests. When the owner invests money, the owner invests equipment, the owner invests anything of their own into the company, you've been putting it into the capital account. Capital is going to increase your owner's equity. That's a plus sign. It increases the owner's equity. Revenue, money coming in. This is your income. It's your income, in being the keyword. So it's going to increase your owner's equity. Drawing is if the owner withdraws money. That's why it's called drawing. Okay? And when the owner withdraws money, it's going to bring the owner's equity down. And then expenses, as we just discussed, are the cost of doing business. And when expenses are incurred, it's going to bring the owner's equity down. So now that we've introduced these 4 new accounts, really 3, because you are familiar with capital, the accounting equation is going to look a little different. So now it's going to look like assets equals liability plus capital. It's no longer owner's equity, right? Capital plus revenues minus expenses minus drawing. Okay? And remember that all of these things are owner's equity, which is where we get the assets equals liabilities plus owner's equity. All right? So let's take a look at some transactions. All right. So, you know what? Before we can look at the transactions, let's talk about what is known as the chart of accounts. I'm getting ahead of myself. So the chart of accounts is the official list of accounts. And the key here is it's tailor-made for a business. So no 2 chart of accounts are going to look the same. All right. There are some similarities, but they will not look identical. So when we talk about the chart of accounts, it's broken up into what you see here are 5 categories. You have your assets, then your liabilities, then your owner's equity, revenue, and expenses. So your assets are listed in liquidity. And if you should recall from your financial literacy course, and if you haven't had financial literacy yet, liquidity means how quickly something can be turned to cash. So when we think of liquidity, if something is liquid, how quickly an asset can be converted to cash. Okay, so obviously the most liquid asset is cash. It's already cash, okay? Then you have accounts receivable. That's when you sell things as a company. It's your profits, but the people owe you the money. They haven't paid you yet. So basically they're buying on account. Supplies, prepaid insurance, equipment, so on and so forth. Your liabilities are all your creditors, people that you owe money to. Owner's equity is made up of capital and drawing, okay? But it's also, don't get confused, it is also made up of revenues and expenses, but on the chart of accounts, just capital and drawing go under the owner's equity account list. And then you have revenues and expenses. The numbers are generally what they're listed by. So assets they range from 100 to 199, liabilities 200 to 299, so on and so forth. Okay. And account numbers will become more important as we move through the course. All right. All right. Let's do this real quick. Identify the revenue expense accounts from the following list of accounts. If the account is a revenue, we're going to write an R. If the account is an expense, we're going to write an E. If it's neither, we're going to leave it blank. Okay, so accounts payable, and we're going to take this a step forward, a step further. So accounts payable is actually going to be an L, right? So our L is going to represent liability. Okay. Rent expense, that's an expense. Drawing, J. Martin drawing, that's actually going to be OE for owner's equity. Here we go again. I have not gotten any better. Okay, OE, owner's equity. Okay, but remember, revenues and expenses still affect the owner's equity. Okay, they fall under that umbrella, but they're not going to be classified on our chart of accounts as owner's equity. Wages expense, that's an expense. Service income, keyword here would be income. That means it's a revenue. Utilities expense. Professional fees earned, fees is your keyword here. That's a revenue. And accounts receivable is actually going to be an A. An A, we know, represents assets. All right. So, business transaction. There are quite a few here. So, here we go. Remember our steps in analyzing. We're going to ask ourselves what accounts are involved and is cash changing hands? Because we know if cash is changing hands, that is going to be one of the accounts. The classification of the accounts involved. Remember, if they're on the same side of the equation, they have to move in opposite directions. Are the accounts increased or decreased? And is the equation in balance after? All right, so here we go, the first transaction. Company sold services for cash, $8,000. Okay, so what our accounts are involved is cash changing hands. So we know it's for cash. So we know that cash is changing hands. And when we see sold services, that is going to key to you income from tours. Now, why income from tours, you may ask? Well, that is the particular revenue account that is being used with this company. Okay, so actually I think it should be up in this chart of accounts. Don't make me a liar. Yes, okay. So income from tours, that's the revenue account, all right? Depending on the business, it could be something different, all right? It could be, this is a touring company. They give you bus tours in like the city and stuff. So let's say if you were a food truck, right? Yours could be income from food sales, okay? It doesn't matter. It's just whatever the company has decided that they're going, the account the company has decided they're going to put all of those transactions into. Okay, so that's why we have income from tours. So the classifications, we have an asset and we have a revenue. Okay, are they increased or decreased? Well, our asset is going down. Oh, I apologize. They're paying us cash. Our asset is going up. And our revenue, the money that we're earning, is also going up. So let's plug this in. So over here, we're going to put 8,000. And then over here, and I want you to put a plus sign there so you know that it's an increase in cash. And we're going to put a plus sign over here for revenue, 8,000. And underneath it, we're going to write the name of the account, income from tours. Okay. And then we need to make sure that our equation is in balance. So you can see here that it is, right? You can see here that it is, but let's bring our totals down just for good measure. 58,000. And then over here, 8,000. Okay. All right. So that's the first transaction, which is actually transaction F. These transactions are building off of the previous ones that we did. All right. Transaction G. Company paid rent, and it's saying that that is an expense for the month, $1,250. All right. So our first question, cash is changing hands. So we know that cash is one of the accounts. Okay. And this is an expense. So if we were to look at our chart of accounts, we would find the correct expense. And the correct expense here is actually called rent expense. Okay. Classification, we have an asset and we have an expense. All right. Now, what is happening, right? Our asset is going down. Okay. Our expense is going up. So now you're sitting there and you're going, all right, Mrs. Dowdell, you told me that if they are on opposite sides of the equation, which they are, they need to go in the correct direction. Yes, the same direction. Yes, that is a fact. Okay. But watch. This is a negative 1250. Okay. The total expenses that we put out there, the total amount of money that we spent did go up. But it's going to be subtracted out when we bring it down into this spot here. Okay, so watch what happens. Cash is 58,000. We're subtracting out 1,250, gives us a new balance of cash of $56,750. Expenses, okay? Yes, the total amount that we spent went up. But look, it's subtracted out of the equation. And what did we do over here? We subtracted the cash out. It can get a little confusing. All right. So you have to think the total expenses paid is what went up. Okay. But the effect on the equation is what went down. Okay. All right. We'll be looking at more like that. So just stay with me. All right. Transaction H. Company bought supplies on credit for $675. So there's no cash changing hands here. Okay. We know that we are getting supplies and we are buying on credit, which we did cover in the other transactions. But just a reminder, that is accounts payable, which I will abbreviate AP. Okay, not Adrian Peterson. Haha. I don't even know if he still plays anymore. Probably not. All right. AP is accounts payable. Classifications. We have an asset and a liability. Our asset is going up. Our liability is also going up. Okay. So supplies, we're going to plug in our number, 675. Accounts payable, 675. And then when we update our totals, we see that our equation does balance. Okay. Moving along. Company paid for insurance, or they paid cash for insurance, $1,875. All right. So cash is changing hands. When we are dealing with insurance, it goes into a category or an account called prepaid insurance. Why? Because when you pay for your insurance, you pay it up front. So that's why it's called prepaid. Okay, so you're paying it up front. All right, cash is an asset. Prepaid insurance is also an asset, right? We have one asset going down, our cash. We have another asset going up, prepaid insurance. Same side of the equation. Okay, so cash minus 1875, prepaid insurance plus 1875. Okay, and then when we put our new totals in, our new balance in cash is $54,875, and prepaid insurance is $1875. And we see that we do balance. Okay, so that's the transaction for insurance. All right, company received a bill for an expense, $620. Received a bill. Okay, they received a bill. They paid no money out. Okay, so that's going to indicate to you that we have to pay it later. It's a liability. It's going to go into our accounts payable. And this is an expense. So we're going to put it into, it's actually an advertising expense. It should say that. I had to look at my notes there, but this is an advertising expense. So it's going to go into advertising expense. Don't mind my R's, they look like V's. All right. So classifications, we have a liability and we have an expense. Are the accounts increased or decreased? Okay, so our liability is going up because the amount we owe people is going up, and our expense is going up. So here it is again. Mrs. Dowdell, you told me same side of the equation is going to go in opposite directions. It has a net effect of opposite directions. That's what you need to remember, a net effect, meaning what it's actually doing to the equation in the end, the net. So we're increasing our liabilities by $620. We are also increasing the amount that we have spent by $620, and we're putting that into the category or into the account of advertising expense. Okay, we're increasing the amount that we spent, but it is having a negative net effect on the equation. So you have one going up and one going down. Okay, so that's, you got to really wrap your head around that. It's a tough concept to think about. But when you're thinking about these, expense, you're thinking about the total expenses paid and what that effect, that net effect has on the equation. Okay, so the more you do it, you'll become more comfortable with it. So over here, we're going to have an increase, right? So our accounts payable becomes $36.15, and our expenses, we increase the total, so that's going to be $18.70, and it's going to be subtracted out, right? So again, we had an increase and we had a decrease. Okay, all right, moving along. I went the wrong way. Yeah, I gotta go this way. All right. I told you there were a lot of transactions. Transaction K. Companies sold services on account for $67.50. All right, so we've done this before. The sold services part. On account means we're getting no cash. They have to pay us later. So we are going to be introducing accounts receivable. AR is accounts receivable. So accounts payable is the money that we owe. Accounts receivable is the money we are owed, that someone has to give us. Okay, so we're increasing. So accounts receivable, I answered that question, right? And then the other account is going to be income from tours, which is your revenue account. Okay, so we have an asset. It's a good thing. And we have a revenue. Asset is going up. Our revenue is going up. So when we plug this into our equation, we have a plus $67.50. And then we have a plus $67.50 over here. And that account is income from tours, which we've done before. And then when we update our totals, $67.50. And then we have $14,750. Okay, so that's selling services on account. All right, L. Company paid a creditor on account. Okay, paid a creditor. All right, we're paying a creditor. That should key in your head accounts payable. Okay, and what are we paying them with? Cash. So cash is changing hands. So we have cash and accounts payable. Okay, classifications, asset and liability. Our assets are going down, but our liabilities are going down. Okay, so we are paying out a cash amount of $1,500, but we are also paying out $1,500 of our debt. We owe $1,500 less dollars. Okay, so you can think of your accounts payable. You can almost think of it like your credit card. So the credit card for the business. Okay, credit card for the business. All right, so when we update our totals, let's make sure I'm writing the right ones here. We have $53,375. And then we have $2,115. Okay. All right, moving along. M, we're getting there, guys. Company paid an expense in cash. We paid an expense in cash. And again, the expense really should be stated here. It looks like it's going to be a utilities expense. Okay. Like paid, like, that would be like your water bill, right? Or the electric bill. Those are samples of expenses. Okay. So what accounts are involved? Well, we know we're paying cash, and it's utilities expense, like I just said. Okay. Cash is going, classification, I'm getting ahead of myself. Sorry. It's been a long day. Okay, so cash is an asset. Utilities expense is an expense. Okay. Asset is going down. Expenses, here it is again, guys, is going up. The total amount of expenses is going up, but it's going to have a negative net effect on the equation. It should start clicking now, right? This is the third example. Should start clicking. If you are still struggling with that concept, drop into my WebEx hours, email me. So let's set up a time. Let's get it under control. Let's get the confusion squared away before we get into a situation where you're very, very confused. Okay. All right. So we have a decrease in cash, $225, but an increase in our expenses because the total amount that we're paying in expenses has gone up. So our new cash balance is going to be $53,000. I'm running out of room here. $150, and our new expense is going to be $2,095 total expenses. But again, net. Negative effect. Okay. All right. Transaction N. Company paid a creditor on account cash. Okay, so we're seeing creditor. But they didn't say cash, but if we're making a payment, we know it's cash. Okay. So we know we have accounts payable and cash. That's why we always ask, is cash changing hands? It's going to be like 50% of your transactions are going to involve cash. Okay. So classifications, we have a liability and an asset. Our liability is going down, but our asset is also going down. Okay. So cash is going to be a negative $620. Accounts payable, negative $620. And then we update our balances. I have to turn my page. $52,530. And accounts payable, $1,495. Okay. Okay, transaction O. Company paid an expense in cash, $2,360. This particular expense, they paid salaries. All right, and when you pay salaries, that means it's wages. So sometimes the account will be called salaries expense, and sometimes it will be called wages expense. All right. So they paid cash. So we know it's cash and wages expense. Okay. Cash is an asset. Expense is an expense. The asset is going down, but the expense is going up. Okay, here it is again. All right, so we're going to subtract out 20, but we're going to increase the total amount of expenses paid, but we add to then back it out, okay? So 52,530 minus 2360 is going to bring us down to $50,170. That should be in that box there. And then expenses, we now have a new total of expenses paid, $4,455. Okay? All right, transaction P. All right, so this is our first 3 account transaction. So company buys equipment on account. So we're seeing equipment, we're seeing on account, and we're seeing it's a total of $3,780, making a cash down payment of $1,850 and charging $1,930. So there are 3 accounts. We have cash, we have equipment, and we have accounts payable. Okay, we know it's payable because we're charging an amount. So we have an asset, and we have a liability. All right, so we're going to have one asset going down, one asset going up, and a liability going up. Okay, so let's see how this works. We put $1,850 in cash down. So it's hard to see. Let me rewrite that. Minus $1,850. Okay. We got a total worth of equipment in the amount of $3,750. And we also increased the amount of liability that we owed, $1,930. Okay. So let's take a look at what this does to the totals and how it balances out. Our cash is going to drop down to $48,320. Our equipment is going to go up $5,100. Okay, and then we're going to see our accounts payable is going to go up $3,425. Okay, and when we add these up, we see that the equation balances out. Okay, so this one was a little more challenging to look at when you're thinking of same side of the equation, have to go in opposite directions. Yes, you subtracted $1,850, but you added $3,780. So you had to add the difference on the other side of the equation. Okay, so that's how it's keeping that equation in balance. All right, so we got a total of $3,780 of equipment. $1,850 of it was in cash, and $1,930 was charged. Okay, so that's a 3 account transaction. All right, Q. Company receives cash on account from a credit customer. Okay, so credit customer should key to you accounts receivable. All right, and we're receiving cash. So cash is changing hands, and the other account is going to be accounts receivable. I didn't need to write that all out. They're both assets. One asset is going up, and another asset is going down. So we're receiving, and then the balance in our accounts receivable, the balance of the amount of money that people owe us, is going down. So cash goes up. The balance that people owe us goes down because they paid off that debt. Okay? And when we do that, we get new balances of $50,820 in cash. And we have a new accounts receivable balance of $4,250. All right, last two transactions. Here we go. Transaction R. Company sells services for cash. All right, we're selling services and we're getting cash. So we know it's cash. And anytime we sell services, we know that it's revenue. So this is going to be income from tours. Okay. Cash is an asset. Income from tours is a revenue. Our asset is going up and our revenue is going up. All right. And we are increasing revenue by $85.70. And it's going to say income from tours. Okay? And so when we update those totals, we see $959,390 total. And our new income from tours total is $23,320. Okay, and we're still in balance. All right, last but not least is the, I think that's it. This should be the last one. Yep. Last but not least is a withdrawal. So this is a drawing. Okay. So owner makes a cash withdrawal of $3,500. Okay. So we know cash is changing hands, taking cash out, and the other account is going to be J. Connor drawing. Okay. Cash is an asset. J. Connor drawing is owner's equity. Okay. Remember, capital and drawing, we list as owner's equity. Even though capital, drawing, revenues, and expenses all affect owner's equity, capital and drawing are in the category in the chart of accounts under owner's equity. Okay. All right. So our asset is going down and our owner's equity is going up. Uh-oh, Mrs. Dowdell, it's happening again. Opposite sides of the equation. They're going in opposite directions. They should be going in the same direction. Your drawing is going to work as the same way as your expense. So it's going to have a net effect. It actually brings the owner's equity down, but the account balance itself, the amount that you took out, went up. And let me just clarify for you what a drawing is. The owner decides they need money. So a quick way they can do that is they can go take money right out of their business. And that's what a withdrawal is. That's what a drawing is. Okay? So we're going to see a decrease here. Okay? And then we're going to put over here an increase of $3,500. It doesn't increase the equation. The amount that the owner took out increased. It's still going to have that negative effect on the equation. Okay? So when we bring that balance down, it's $3,500, but again, it is subtracted out. Okay, I know that was a lot. That was a lot of transactions, right? That's examples of pretty much everything you're going to see for now. Okay, so this lecture is very important to go back to if you're running into issues and you're saying, I don't remember revenues, expenses. I don't know what's happening to the equation. This is where you want to come, and you can fast forward and get to what you need. Okay.